There's a great deal of discussion about slowing international economies and what that means for the U.S. Certainly Germany and China, two of the top economies in the world, are starting to report slower growth, and that could weigh on the U.S. economy. Most specifically, international trade and foreign sales by multinational American companies could be affected. Apple, for example, has already reported slowing, particularly in China. So as the economies in foreign countries slow down, what that's going to do is it's going to put downward pressure on their treasury rates. And so as a result, there will be more inflow of foreign capital into U.S. treasuries, which in turn pushes down the interest rates on U.S. treasuries and therefore interest rates on mortgages for commercial real estate. So on one hand, this could have a positive effect for commercial real estate investors because it could reduce the cost of capital for investors in the U.S. However, it does also weigh on the outlook for U.S. growth. It creates additional uncertainty for sure, but it's very unlikely that this will translate into a U.S. recession. As a direct result of this. Again, we still anticipate pretty strong growth in the U.S. in 2019, and this will just certainly slow it down just a little bit. Now, for the Federal Reserve, this creates a little bit of a whipsaw. A month ago, they were talking about risks of overheating, inflationary pressure, and they were pushing rates up. Now they're looking at being much more accommodative, and they're more likely to hold rates where they are and perhaps slow or stop the quantitative tightening they've been doing. So the Fed may stop putting upward pressure on interest rates in the coming year and ease back a little bit. So what's this mean for commercial real estate? 2019 still looks good. Even though we're starting to see a little bit of issue out of Europe and Asia, the economy is still strong in the U.S. The overall fundamentals in commercial real estate are exceptionally strong. We're seeing some of the highest occupancy levels across the board in all property types. So even if the economy slows down a little bit, that just means there's a little bit less upside potential on an already strong result. The reduced cost of capital will be beneficial for transactions, and the potential for increased investor caution is really just a gut response to an unknown. The fundamentals for commercial real estate remain sound, and understanding the local demand drivers of each asset remains exceptionally important, because regardless of what's happening at a macro level, an individual asset may outperform or underperform depending on what's driving that particular property. So investors really need to pay attention to those fundamentals when they're looking at each property.